Hi, in this video we'll be looking at another source of risk in financial assets, and this is going to be business cycle risk. So what is this? Well, it's the risk of investments making a loss due to business cycles, and we can also think of this more specifically as recessions causing investments to make a loss. And you may also see this referred to as cyclical risk, but it is just the same thing. So business cycles can adversely affect the returns of an investment or an asset class. Individual companies' profits will also be affected, so there will be an effect on, say, dividends and just generally the prices of stocks. So before we get into exactly how business cycles have an impact on asset prices, what actually are they? Well, it's been shown that the economy as a whole tends to move in cycles, and these cycles are peaks and troughs. So we know that over time, if we just draw up a quick graph, we have time and we have sort of GDP, so the amount that an economy grows over time, and we tend to view our economies as growing over time. So this GDP will be increasing, and say a sustainable rate of growth could be seen as 2.5%. However, we don't tend to have growth just in this linear way. We see cycles, so our economies grow more like this with ups and downs, and we call this a cycle. So we have, say, at the top of the cycle, we'd call this a peak, and at the bottom of the cycle, we'd call this a trough. And so say between a peak and a trough, so we've got another peak up here. Between a peak and a trough, clearly our GDP is increasing, so our economy is growing, and we might call this section a boom or a period of economic growth, and the other area where we have decreasing economic growth, we'd call this, say, a downturn or a recession, and that's where we have our GDP is decreasing. So apologies that diagram is quite small, but you get the idea. We have these sort of cycles. We have a peak, and then this goes down into a trough, and then we have another peak, and this goes down into another trough, and so on. So on average, our growth is going up, but in the short term, it goes up and down. So for business cycle risk, we're going to focus on downturns primarily. So this is where our economic activity is slowing down, our economy is going through a recession, and these are usually associated with poor market performance. We all know, say, in 2008, we had the Great Recession, and in this time of poor economic performance, even negative economic growth, the markets did very badly. Most stocks decreased in value, as is the next point. Why is this? Well, it's because we have reduced economic activity. In these times, people are going to be spending less money, so our individual companies and just our economy as a whole is going to earn less profits or just make less money. There is also, say, uncertainty surrounding future returns, so investors may prefer to hold money as cash, which is more flexible, rather than having their funds tied up in, say, long-term investments. So this is all going to decrease, say, stock prices and the value of financial assets. So this is why we say that downturns are associated with poor market performance, and it's a reason why investors are monitoring the economy very closely, because they want to know if there's a risk in the near term that their investments are going to decrease in value. However, there are some exceptions to this rule. It's not as though every single financial asset is going to decrease in value because of a recession. So some stocks react differently to the business cycle. For example, companies that sell cheap necessity goods may perform better during times of economic downturns. People will always need to purchase goods like food and clothing, and some consumers will even increase consumption of cheaper goods as they look to cut costs by switching away from more expensive products. So some examples may include Primark in terms of discount clothing and Aldi in terms of discount food. And so, for example, Aldi in the 2008 recession, its stock prices did very well because people would switch from more expensive supermarkets like Waitrose to, say, the cheaper supermarkets. Recessions are a time of high unemployment, so people are going to have less money, so they're going to save by buying cheaper products, so these stocks can go up in value. And this is why investors often like to hold some of these stocks in their portfolios in order to diversify. So even in times of downturn, some of their stocks are going to increase in value so they can still make positive returns overall. So that is some insight into business cycle risk. I hope you found this useful. If you did, please do leave a like rating. Make sure to check out the channel for more videos like this one and subscribe to add some econ to your subscription feed.